Moving to thing number three, we're going to pull Alex into this one in terms of conversation. We're talking China and their economy. We've talked about this in the past as well, just the struggles that are there. We saw bond yields down a lot. Thing number three, Gary or Alex, China, a snapshot of contradictions. Whichever one of you wants to take that one first.
Take it over, Alex. Go.
Yeah, so we have seen, the 10-year and 30-year Chinese government bonds are obviously, I think, yeah, at their lowest ever. And I read a fantastic thread recently by Macro Alf, and he was explaining kind of why this is happening and why China are cutting rates so much. And it kind of really goes back to 2008, and after the 2008 crisis, a lot of the Western countries, they had a lot of private debt, but they managed to deal with that problem, and China has not dealt with that problem. And so Macro Alf was saying that the private debt to GDP is ratio is around 200%, and we saw kylebass say more like 350%, and obviously that's a wide range, but either way, I mean that's massive. And so China, and this term japanification, which we've heard a couple of times on FinTwit and um, online, and China is essentially trying to do what Japan did in the 90s when they had their housing bubble. And I think Japan tried to cut their rates from, they slashed them from about 8% to 1%, to, just stimulate as much aggregate demand as possible, because the deflationary pressures were so strong. And, China is having the exact same problem. And so, um, China's corporate debt from 2010 to 2016, that really started to pick up, and then it got kind of shifted, into the housing market. And right now it's looking like, they may have to push it up to the sovereign level. And so, there's a lot of speculation about potential yuan devaluations in the future. And, I that's what I'm expecting.
Gary, anything you would add to this point? Questions that you might have for Alex to elaborate on?
Well, the one thing I want to clarify, when Alex talked about the Chinese government bonds being at their lowest level ever, he's talking about the yield. So the
Yeah.
bonds are actually more expensive than they've ever been. It's the yield that's down. And what that means is that people are paying a lot for Chinese bonds. And as a result, the interest rate that they're getting is a very low interest rate. It's the same thing that we saw here in the US, basically the prior 15 years ahead of COVID, when we were, when we had our Fed funds rate around zero. And I think, the US 10-year was trading below 1% for a substantial part of that time. So that's basically what China is doing right now. They know they've got a problem and they're stimulating. And, that's actually not a bad thing for Las Vegas Sands, which is, one of our stock picks. Because basically, if the Chinese government is going to stimulate and spray money into the economy, just like our government did here, well, that's not bad if you're running a gambling establishment.
Alex, anything else before we close out this point?
No, that's all from me. Thanks, Rob.